Gold and silver are not calming down right now, they're compressing. And the people who only watch the headline price are about to get blindsided by the part of the market that actually forces movement. Because the fight isn't happening on your screen. It's happening in the plumbing, in margin requirements, in liquidity that thins when everyone thinks the holiday hangover is over, and in the quiet physical premiums that start whispering again exactly when the paper crowd is convinced the move is finished. Stay with me, because in a few minutes, I'm going to give you the 2-scenario map for the next 1 to 2 weeks, the levels that matter. What would confirm the bullish continuation, what would invalidate it, and the one hidden stress signal that tends to lead price when the market is trying to pretend everything is normal. Here's the first uncomfortable truth. A big chunk of the selling you've been watching in metals is not someone deciding rationally that gold and silver are suddenly bad assets. A lot of it is forced behavior, and forced behavior creates fake weakness. It creates candles that look like failure while the underlying positioning gets healthier. That's why you can get a vicious drop that feels like the end, and then the market turns right back around and rips your face off. And that's where the real pressure starts. Let's ground this before we get cinematic. Gold is still sitting in a historically elevated zone after a monster year, and silver is still trading in a region that would have sounded absurd not long ago. Even after sharp shakeouts, we're not talking about some sleepy, sideways commodity complex. We're talking about assets that have been printing huge ranges, punishing indecision, and forcing anyone with leverage to either pay up or get out. That matters. Because when a market is already elevated, the next move is rarely polite. It's typically either a controlled retest that resets the trend, or a continuation squeeze that detonates through levels while you're still waiting for confirmation. And the next detail is what flips the whole setup. The detail is this: the price you see is not always the price that matters. In metals, the headline price is the loudest number, but it's not always the most honest number. The honest numbers are often quieter. They're in the spreads, in the curve, in the premiums, in the places where metal actually changes hands. And when those quiet numbers start acting differently than the loud one, you get a warning. Not of what happened, of what's about to happen. So let me tell you the story the mainstream almost always misses in real time. When volatility spikes in silver and gold, people love to narrate it as emotion, fear, greed. Risk on, risk off. And sure, emotion rides shotgun. But the driver is usually mechanics. When the market is leveraged, it's a machine that reacts to rules and constraints, not feelings. If you understand the constraints, you stop getting whipped around by the drama. But if you don't understand them, you'll keep mistaking forced selling for genuine reversal, and the market will use that against you. Let's talk about one of the most powerful levers in the entire metals complex: margin. Futures markets are the spine of price discovery for these assets, whether people like it or not. Even if you never touch a futures contract, futures positioning influences the spot price you see, the dealer hedges behind the scenes, and the way liquidity providers quote. And futures markets are governed by margin requirements. Margin is the cash you must post to control a contract. When volatility rises, exchanges can raise that requirement. That sounds boring. It is not boring. It's a forced behavior switch. Here's the mechanical chain reaction. Volatility rises. The exchange or clearing firms say, risk is higher, we need more collateral. Margin requirements go up. That means anyone holding leveraged longs or shorts must post more cash. If you're a big player with deep pockets, you grumble and wire more. If you're a smaller player, or you're a fund juggling many positions, you don't get to have an opinion. You get a demand: pay up or reduce. And when lots of participants reduce at the same time, price drops not because the thesis died, but because the rules tightened. That's why you can see a brutal sell-off immediately after a margin hike. It's not a moral judgment, it's accounting. Now imagine that happening in silver, which is already the more volatile sibling. Silver doesn't just move more than gold, it moves differently. It has a thinner market structure. It has more violent squeezes and sharper flushes. It can gap on you emotionally and financially, so when margin rises there, it hits like a hammer. People who thought they were early become people who are wrong on a timetable. And the market doesn't care if you're right later. It cares if you can hold now, because if you can't, you become supply at the worst time. But that's not the part that matters. The part that matters is what happens on the other side of that forced selling. After the leverage gets flushed, you often get a cleaner setup, a market with fewer weak hands, a market where the next upward push requires less fuel to trigger short covering and rehedging. And the proof of whether that S happening does not show up first in your favorite influencer, S candle chart. It shows up in real-world symptoms: premiums, availability, the way physical buyers react to dips, the way dealers stop discounting, the way certain hubs quietly pay up again. That's your hidden detail. If you only watch the COMEX or a spot ticker, you miss the physical pulse. Physical buyers are not a monolith, but they share one trait: they respond to value. When price drops hard, physical demand often shows up if people actually want metal and can get it. And one of the best tells is what happens in major consumption centers, where premiums can expand when demand returns faster than supply can flow. When you start to see those premiums firm up after a correction, it implies something very simple and very powerful. The dip is being bought where it counts, quietly, methodically. And if the paper market is still fragile from margin pressure and positioning shifts, that physical bid becomes a floor that paper eventually has to respect. That's where the real pressure starts. Now let's widen the lens, because metals are never just metals. They're macro. Gold is a monetary metal, a trust asset, and a hedge against policy confusion. Silver is a monetary metal that also behaves like an industrial commodity with a split personality. When macro winds shift, gold often moves first, calmer but persistent. Silver follows later, louder and more violent. That dynamic matters right now because we are stepping into a calendar window where macro repricing can happen fast. This is January. The market has just rolled past year-end positioning, tax-related flows, and all the window dressing that makes charts lie. Early January often carries thinner liquidity and larger sensitivity to data surprises because positioning is being rebuilt. New risk budgets, new mandates, fresh hedges. And when liquidity is thinner, moves travel farther. That's not hype, that's microstructure. When there are fewer resting orders and less depth, price gaps more easily. That is why you can get what feels like random, violent moves in the first couple of weeks of the year. They're not random, they're amplified. Now layer in the near-term calendar triggers. Within days, the market faces key U.S. macro releases that can reprice the dollar and real yields quickly, and those two variables are the heartbeat of gold and silver. If you don't watch rates and the dollar, you're trading the symptom, not the cause. The U.S. jobs report is a major volatility event. Inflation prints like CPI can be even more explosive if they surprise expectations. And in a world where the market is constantly updating its belief about how restrictive policy really is, those surprises matter more than usual. Because if this one level breaks, the math changes. Here's the clean mechanism. Gold and silver care about the opportunity cost of holding them. They don't yield. So when real yields rise meaningfully, the cost of holding metals rises. That can cap rallies or trigger pullbacks. When real yields fall, that cost decreases and metals breathe. The dollar adds another layer. A weaker dollar often supports higher metal prices mechanically because it changes purchasing power and global demand. A stronger dollar can create headwinds. But here is what people forget. It is not just the level of yields or the dollar. It's the change. It's the surprise. It's the rate of movement. Fast moves force hedges. Fast moves force de-risking. Fast moves create gaps. So as we approach these data points, metals are sitting in a posture where the next macro surprise can be a catalyst. That's your why now. Not because you saw a dramatic tweet, because calendar plus positioning plus thin liquidity is a known recipe for outsized moves. And that's where the real pressure starts. Now let's talk about term structure for a moment, because this is where sophisticated signals live. Most people never look at the futures curve. They should. Gold typically trades in contango. That means future prices are higher than spot, because carrying gold costs money, storage, insurance, financing. That's normal. So if the curve shape starts flattening or the near months get unusually bid, it can signal tightness or demand for immediate delivery or unusual hedging behavior. Silver can show similar signals, sometimes more dramatically because its market can get stressed faster. You don't need to be an expert in spreads to use this. You just need one simple frame. When the curve behaves wrong, it's telling you something about pressure. It's not about predicting a precise number. It's about knowing whether the market is relaxed or strained. When strain rises, volatility rises. And in metals, rising strain often means the next move will be sharp. But that's not the part that matters. The part that matters is that the curve and spreads tend to reflect what participants are forced to do. Producers hedge, consumers hedge, funds roll positions, dealers manage inventory risk. When the curve shifts, it changes the economics of holding, rolling, and delivering. That can create feedback loops. For example, if rolling becomes more expensive or less attractive, some positions close rather than roll. If it becomes cheaper, positions persist. These are not moral decisions, they're cost decisions. And cost decisions move markets. Now let's pull in another big number, small float concept, inventories. People love to point at total vault holdings in London or elsewhere and conclude, there's plenty of metal, so there can't be tightness. That almost like looking at a country as total housing stock and claiming there can to be a housing shortage in a specific neighborhood. Inventory totals are not the same as available supply. Some metal is held long term, some is earmarked, some is pledged, some is not economically for sale at current price, some is in forms or locations that aren't OSMIT readily deliverable into the specific mechanism that sets the marginal price. The relevant question is not, is there metal somewhere? The relevant question is there metal available in the right form at the right place, at the right time, at the right price, without triggering a scramble? That's the question spreads and premiums answer. And that's where the real pressure starts. Now let's deal with the institutional behavior angle without falling into cartoon territory. Banks, funds, and large institutions do not need a conspiracy to behave in ways that feel oppressive to retail. They just need incentives. Risk desks are paid to survive. They're paid to avoid tail risk. When volatility rises, they reduce. When margin rises, they reduce. When liquidity thins, they reduce. That reduction can create downward pressure in the short term. And it can feel like suppression if you're emotionally attached to the bullish thesis. But again, it's mechanics. The market is often not debating whether metals are valuable. It's debating whether leverage participants can hold their positions through a stress window. And stress windows are exactly when gold and silver create the best and worst moments for investors. Best if you're prepared. Worst if you're reactive. Now add one more layer. Institutional flows through vehicles like ETFs and structured products. These flows can lag or lead depending on the regime, but they matter because they represent how a broad base of capital expresses the view. If institutions re-risk into gold exposure through liquid vehicles, that can support price. If they de-risk, that can pressure it. But here's the nuance. Flows don't have to be massive to matter at the margin, especially in thinner liquidity. And flows can shift quickly after a macro data surprise. That's why this week and next week matter more than your average week. The calendar is the catalyst. Now let's talk about silver specifically, because silver is where the fireworks happen. Silver's supply chain has a structural stubbornness that most casual commentators gloss over. A significant portion of silver production is as a byproduct of mining other metals. That means silver supply doesn't respond quickly to higher silver prices. If copper or lead zinc economics drive the mine plan, silver doesn't get a simple turn up the spigot response when silver rallies. Meanwhile, silver demand has a heavy industrial component. Technology demand, electrification, manufacturing cycles, and procurement behavior can create real non-financial pull. So silver sits at the intersection of monetary psychology and industrial reality. That's why it can squeeze like a beast when the market gets tight. And that's why it can flush brutally when leverage gets too excited. So what does that mean right now? It means silver is likely to remain the high volatility expression of the metals thesis. If gold is the slow burn, silver is the matchstick. When the setup is constructive, silver tends to move in bursts, often too fast for comfort. When the setup is stressed, silver tends to punish impatience. And the market will try to manipulate your emotions with that speed. That's the psychology trap. Here's how you get manipulated. Price spikes. You feel urgency. You buy because you don't want to miss it. Then price whips down. You feel fear. You sell because you don't want to be the fool. Then price stabilizes and grinds higher, leaving you exhausted and cynical. That cycle is not accidental. It's the natural consequence of a volatile market interacting with human nervous systems. The defense is not pretending you're emotionless. The defense is building a simple structure before you get hit with the candle that makes you want to do something stupid. And the next detail is what flips the whole setup. The detail is the two-scenario lens. You do not need to predict. You need to prepare. Right now, for gold and silver, there are two clean near-term scenarios that cover most of the realistic outcomes, and both can be tradable or investable depending on your horizon. Scenario one is the controlled pullback and retest. Price dips, volatility cools, levels hold, and the market confirms strength by refusing to break key support. This is the boring scenario that feels wrong in the moment because it looks like weakness, but it builds a base. Scenario two is the continuation squeeze. Price doesn't give you the clean retest. It consolidates briefly, then punches through resistance in a fast move, often triggered by a macro surprise, a positioning imbalance, or thin liquidity. This is the scenario that creates gap risk and FOMO. And if you're not prepared, it either leaves you behind or tricks you into chasing the worst candle. Because if this one level breaks, the math changes. So let's talk levels, because levels are where forced behavior clusters. You don't need a perfect chart. You need reference zones. For gold, watch the near-term support region around the recent consolidation lows. If gold holds the area that has repeatedly attracted buyers on dips, it tells you the market is absorbing supply. If that area breaks decisively and can't reclaim quickly, it signals the pullback may have more room. On the upside, watch the recent swing highs and the psychological round number zones where sellers have shown up. If gold clears those highs and holds, it's a sign that the market is stepping into the next leg rather than topping. For silver, the zones matter even more because the swings are larger. Watch the post-shakeout support band where buyers have repeatedly defended. If silver holds that band through a macro week, that's constructive. If it breaks and accelerates lower, that's the market telling you leverage is still unwinding. On the upside, watch the prior spike zone that acted like a ceiling when the market got overextended. If silver reclaims that area and holds, it's not just a rally, it's a squeeze signal, and that's where the real pressure starts. Now I'm going to make this practical because theory doesn't pay your bills. Over the next 1 to 2 weeks, you should be watching 3 external variables and 3 internal variables. The external ones are the US dollar, real yields, and the market's interpretation of policy path based on data surprises. You don't need to be a macroeconomist. You just need to see whether the dollar is strengthening or weakening into key releases, and whether real yields are rising or falling in response. The internal ones are metal's ability to hold support on dips, the behavior of spreads, and curve shape during volatility, and the real-world symptom check. Does physical demand show up when price dips, or does it disappear? That combination tells you whether the move is being built on durable demand or just hot money. And now here's the crucial twist. Even if the thesis is correct, price can whip around violently. That is not a bug. That is the feature that transfers metal from impatient hands to patient hands. Volatility is the toll booth. The market charges you volatility to hold a position. And the way it collects is by making the correct position feel wrong multiple times before it pays. If you can't psychologically withstand that, you will exit near the lows and re-enter near the highs. The market is designed to encourage that behavior. Your job is to refuse the design. So what do you do instead? You separate trend signal from noise. Trend signal is a level holding, a retest succeeding, a higher low forming, a breakout that doesn't immediately fail. Noise is a single violent candle during thin liquidity, a headline-driven spike that fades, a stop run that snaps back. Trend lives on the time frame you care about. If you're investing, the 5-minute chart is noise. If you're trading, the monthly chart is noise. Decide your horizon, then judge the move on that horizon, and that's where the real pressure starts. Now, let's address the skepticism directly, because I know a lot of you are institutional skeptics. You've watched markets long enough to know that narratives get sold to the public after the move already happened. You've watched experts explain what the market did yesterday with certainty while missing what mattered last week. So the question isn't, are gold and silver bullish? The question is, what is the mechanism that forces the market to accept that they are re-bullish, and when does that force activate? The force activates when supply meets inelastic demand under constrained liquidity and constrained leverage. Not in theory, in practice. If physical demand firms and paper leverage has been cleaned out, the next upward push can be surprisingly aggressive because there's less weak supply. If macro catalysts weaken the dollar or soften real yields, the bid can return. If participants who were short get trapped above resistance, they must cover, and that covering is buying. If options-related hedging ramps into a breakout, dealers may have to buy as price rises to stay hedged, adding fuel. You don't need all of these at once, you just need enough of them to align. And the next detail is what flips the whole setup. The flip is that metals don't need a perfect macro environment to rise. They need a macro environment that is uncertain enough to keep trust assets bid, and a market structure that is tight enough to amplify the move. If the world were stable and predictable, gold would still have a role, but it wouldn't be urgent. Urgency comes from regime change, from currency stress, policy confusion, geopolitical risk, or the perception that real purchasing power is being managed rather than protected. And even without dramatic headlines, the slow grind of currency debasement narratives and fiscal realities can keep gold supported. Silver then rides the wave but adds its own industrial and supply constraints. That's why this is not just a trade, it's a structural story with tactical windows. And we're in one of those windows. Now, about that hidden detail again, because this is the part you can actually use. When physical premiums in major hubs stop collapsing and start stabilizing after a correction, it's a tell that real buyers are stepping in. It means the dip is being treated as an opportunity, not as a warning. It's not a guarantee, but it's a strong piece of evidence in a proof stack. And the proof stack matters. Never rely on one argument. The market will shred single argument traders. Stack your evidence. Here's what the evidence stack looks like in plain language. 1, we're still in an elevated price regime after a huge run, meaning the market has already accepted higher prices as plausible. 2, recent volatility has been amplified by mechanical constraints like margin and risk control, meaning some selling has been forced rather than thesis-based. 3, macro variables like the dollar and real yields are in play with near-term data catalysts, meaning repricing can happen fast. 4, physical demand symptoms can reappear on dips, suggesting underlying bid. 5, structural silver constraints, including byproduct supply dynamics and industrial demand, can make silver's upside violent when the market tightens. 6, calendar effects in early January and around major data releases can magnify moves due to thinner liquidity. Put those together, and the conclusion is not guaranteed moonshot. The conclusion is high potential energy. And markets with high potential energy move, often suddenly. Now let's go to the next 1 to 2 weeks roadmap, because this is where you either become the person who reacts or the person who is ready. Expect volatility around major macro releases. Expect fakeouts. Expect intraday moves that feel like the market is trying to personally insult you. That's normal. In scenario 1, the controlled pullback, you'll see dips into support that get bought, followed by attempts to reclaim prior highs. Confirmations are simple. Support holds on closing basis on your time frame, and rebounds don't get instantly rejected. The market accepts higher prices by staying there. In scenario 2, the continuation squeeze, you'll see consolidation that feels boring and then a sudden expansion through resistance, often on a catalyst. Confirmations are a clean break and hold above resistance and a lack of immediate reversal. If you get a breakout that fails the same day and can't reclaim, that's not a confirmation. That's a trap. Because if this one level breaks, the math changes. Now, what weakens or invalidates the bullish near-term setup? The simplest answer is a decisive breakdown below key support zones that does not recover quickly, combined with macro headwinds that strengthen the dollar and push real yields up. If the market gets a hot inflation print and the response is that yields surge, the dollar strengthens and metals can't hold support, then the pullback scenario can turn into a deeper correction. That doesn't kill the long-term thesis automatically, but it changes the timeline. It tells you the market needs a reset. And resets can be deeper than people expect, especially in silver. That's why risk framing matters. So let's talk risk management in a way that doesn't sound like a lecture. If you are holding metals, the biggest mistake is confusing conviction with position sizing. You can be right and still get knocked out by volatility if you size too big or use leverage. You can hit support through a drawdown. Metals are famous for making believers suffer before they reward them. That's not a myth. That's the nature of the asset class. The volatility is the tax. Decide how much tax you can pay without panicking, then build around that. And remember the two scenario lens. If you only prepare for the squeeze scenario, you'll get emotionally destroyed by the retest. If you only prepare for the retest, you'll hesitate during the breakout. Prepare for both, and you stop getting played. Here's a simple psychology shield you can use immediately. When price spikes, do not ask, am I missing it? Ask, is this above resistance and holding on the time frame I care about? When price dumps, do not ask, is it over? Ask, did it break support and fail to reclaim? So replace emotional questions with structural questions. That is the entire game. And if you do that consistently, you stop donating your capital to the market's mood swings. Now, let's be honest about the institutional suppression narrative without stepping into fantasy. Markets can be influenced by large participants managing risk, hedging, and liquidity. That's real. But the clean, finance-literate way to think about it is incentives and constraints, not villains. If a large participant wants to reduce risk, they sell. If they want to hedge, they short futures or buy options. If a dealer needs to remain neutral, they buy and sell mechanically as price moves. These actions can create the appearance of someone pushing price. But the reason isn't a secret meeting, it's risk management. The good news is that mechanical behavior leaves fingerprints. That's why spreads, curve shape, and physical premiums matter. They're harder to fake for long periods. And when those fingerprints point to stress, the market eventually has to reconcile. So where does that leave you today? It leaves you with urgency, but not panic. It leaves you with a plan, not a prediction. Metals are in a regime where the next move can be large, and the calendar is loaded with catalysts that can trigger that move. The likely path includes volatility. You should expect it. You should not fear it. You should use it as information. In gold, watch whether the market holds the key support region and whether it can reclaim and hold above recent swing highs. In silver, watch whether it defends its post-shakeout support band and how it behaves near prior spike zones. If silver starts reclaiming overhead zones with speed and refuses to give them back, that's the setup for a squeeze scenario. If it bleeds into support and holds, that's the controlled pullback scenario building a base. Both can be bullish. The difference is your execution and your nerves. And here's the subtle part most people miss. The market will try to get you to abandon your plan right before it pays. Right before a breakout, it will stall and bore you. Right before a reversal, it will hype you. That's not mystical. That's how crowds behave. Boredom triggers impatience. Excitement triggers overconfidence. Your edge is staying boring when the market gets loud. That's where the real pressure starts. So I'll leave you with a final practical checklist you can run this week and next week without becoming a full-time macro nerd. Watch the dollar reaction into and after major data releases. Watch real yields, direction, and speed. Watch whether gold and silver hold their key support areas on your chosen time frame. Watch whether breakouts hold or fail quickly. Watch the curve and spreads for signs of tightness or relaxation. And watch the real-world symptoms, premiums, availability, and whether dips get bought in physical channels. If those things line up, the market is telling you the move is not finished. If they diverge, it's telling you to respect the possibility of a deeper reset. Either way, you're not guessing, you're reading the machine. And if you're the kind of investor who wants mechanics, not slogans, stay close to people who also want mechanics. Not because you need hype, because you need signal. This is a market where being early feels the same as being wrong right up until it doesn't. Keep your framework, keep your levels, respect volatility, and don't let the market rent space in your head for free.